Well, the Fed meets next week and is expected to cut rates once again. But could the recent inflation data that we've seen impact that next move? Joining us right now is former Dallas Fed President Rob Kaplan. He's now vice chairman at Goldman Sachs. And Rob, when we look at the inflation data that we got this week, I don't understand why there's a 100% chance being fed into the markets on the idea that the Fed's going to cut rates. Why should they cut rates at this point?
Yeah, I don't think it's an easy decision. I've felt that there would be two phases in the rate cutting, and this is the end of the first phase, meaning that if inflation is sticky, which I think it is, around the mid-twos, the Fed can probably get the Fed funds rate to 4.25, 4.5. That would mean one more move this next week. But inflation, I think, looks a little stuck here. There's some things better, like on services. There's some things worse, like on food and vehicles. And so I don't think this is a no-brainer at all. And I'd actually, in many of these meetings I go into with a strong point of view, if I were in my former seat, I'd be going into this meeting open-minded and looking to have a debate. I think on the margin, they'll probably cut. I'd probably go along with it. But I think we need to see demonstrable improvement in inflation from here to cut below 4.25, 4.5. And so my SEP would probably be in the neighborhood of 2, not higher, because I want to be very cautious and deliberate after this meeting.
I guess if you look at inflation, there's a lot of questions and a very clear argument for not cutting rates. If you look at the broader economy, it still doesn't seem like there's a great reason for cutting rates. The job market looks okay. If you look at the numbers from Restoration Hardware, which were out just last night, up 18% for November for orders, up 13% for the quarter that ended. Early December plus 30% and expecting the full month up 20 to 22%. That shows like a consumer that is building confidence in a job market that looks pretty good.
Yeah, and I think one of the factors which is going to change, I think, in 2025, and I've been saying this for the last couple of years, we've got an extraordinary level of fiscal spending going on right now. We're just finishing spending the American Rescue Act money, which was $2 trillion over the last few years. We've got Inflation Reduction Act projects, CHIP Act projects, infrastructure projects. And I think some of this strength, I think on the margin, is a little bit artificial. I think one of the key things I'm going to be looking for into the new administration is, will some of these big programs, spending programs, be stood down where we actually get fiscal spending under better control, not as stimulative. But I think that's why you're seeing this year-end strength. Having said that, there's a little weakness in prime age employment on the margin. And so, this is not a no-brainer. The market probabilities as high as they are, I think probably people at the Fed are scratching their heads on that, too, because I think they'll have a real debate.
So, I mean, that's what I mean, a real debate. You've lined up a whole lot of reasons not to cut. What are the reasons to cut?
The main reason for me is, and I look more at levels rather than direction of cuts. At 4.25, 4.5, and if headline inflation is 2.5 or 2.6, we've got a real Fed funds rate of 175, 200 basis points. I think that higher rate is necessary with this amount of government spending. I think, again, if government spending and stimulus is more normalized, which is being discussed, I think we're still, the Fed is still restrictive. It's still fighting inflation even at 4.25, 4.5. But again, a lot of what has to happen in this means not just the rate cut. I think the SEP will matter. That's why I want to reduce the outlook in the SEP. And in the press conference, it's very critical that Jay Powell cautions that we're now going to slow the pace. This is going to be more deliberate, and we need to see more improvement if we're going to act further. That press conference will matter just as much as whether they cut or not.
Is there a risk that the Fed would have to do an about face at some point? I realize 25 basis points doesn't seem like a whole lot, but if you're running the risk of having to change your direction at some point, 25 basis points out of So far we've only seen 75 basis points cuts, so it's a significant portion of what would be the total 1%, 100 basis points. Is there a risk to adding that extra 25 basis points that would make it so you would have to do something else down the road, some sort of an about face?
Yes, that's the best argument for not moving, because having to back up, I think, is unacceptable. If I'm at the Fed, that's a mistake I cannot make. My own view on the margin is we're probably safe at 4.25, 4.5. But again, I don't want to go any further. And then I want to turn my attention to seeing more progress. And I also want to turn my attention to analyzing regulatory review, government spending changes, changes in the energy ecosystem that are coming. And I want to better understand what's going to happen on tariffs, particularly if we have tough tariffs with China. I want to see an open corridor in North America to reshoring to Mexico as well as the United States. I'm going to watch that very carefully. I'd be very concerned if there were high tariffs also on Mexico, because that would limit reshoring. And I want to look at how the job market is going to be affected and workforce growth is going to be affected by these deportations. Deportating criminals, great. Sealing the border, great. But I want to be careful that we don't inadvertently shrink the workforce. We need workforce growth. Workforce growth is disinflationary. And it's one of the reasons why the Fed has been able to do the cuts they've done.